About to leave, already packing. Come with me, I'm not really asking. We'll get away to a place where we don't know. About to see the world in action, what we can be, life with no distractions. We'll get away, this is what we waited for. Looking back, eyes on the freeway, Bonnie and Clyde, a classic cliche. We're on the run, this is what we waited for. Take my hand, we'll make it somehow. We can't miss out. I'm done living life with the lights out, done with my own doubts. Be free.
Evening everyone, it's Jim here at Tutor. Welcome to our second live stream in 2 days, helping you get ready for the Unit 3 exam, which I think is tomorrow morning, isn't it? So be up bright and early for that. It looks like we could be quite busy tonight. We were very busy yesterday afternoon into yesterday evening with personal finance, and this session is on business finance. And already I can see in the live chat we've got over 500, in fact now over 600 students joining us, so that could make the live chat quite difficult to read in terms of questions, but I'll keep an eye out. But also, if you were here yesterday, you'll know that with this session we do encourage you to have a go at these activities. We've got about an hour of revision that is just on business finance and designed to cover as much as we can. So we're not going to spend ages going through exam technique on the 12 markers. We're going to try and cover loads and loads of stuff, hopefully to give you some reassurance that you know lots of stuff, and maybe you know some formulae, you can do some calculations. That reminds me, make sure you've got a calculating implement close to hand, a smartphone or calculating device. Not many people are going to be watching this on replay before tomorrow, so mainly the live audience, so please do use the live chat to have a go at the activities. You don't have to. If you just want to use a piece of paper and jot your thoughts down, we'll go through each activity, and I've tried to mix them up a bit and take our time and explain the answers, maybe explain the calculation, and if we have time I'll try to throw in some supplementary questions as we go. A few shout outs to mention. I know that Farrington School are here. They were one of the crew who were with us all yesterday, as indeed a Blue School, and I'm pretty sure I saw Canterbury College in the live chat about 2 hours before this session started. probably sat alongside Medway, Mid-Kent, and lots of others. So we'll try and give you some more shout outs. By the way, apologies for those who turned up at 11 o'clock this morning expecting the session to start. We moved it to 7 to give more people a chance to attend. If you've been here for the last 8 hours waiting for it to start, thank you. I appreciate that. Okay, so here's how it works. I've got a series of activities, and I won't always appear on the screen. I'll try to get Cambridge Regional College here. Phew, right, we can start. I'll try to put the activities on the big screen to make it easy to read, particularly if you're using your smartphone to watch this session. But occasionally I'll just come back to this view just to show you it's just me on my own tonight. So it is just me. So I'll try to do the activities and explain stuff as well as keep an eye on the live chat. Shall we get going? Right, so it is busy in the live chat, so please only use it just for now for answers to the questions. I know lots of you are asking, what are the grade boundaries going to be? Well, who knows? You know, who knows how many marks it might be to get a distinction? Maybe late 40s, very early 50s, a bit like my age. Maybe, who knows? We don't know, do we? Let's focus on getting as many marks as we can tomorrow in business finance. Are we ready for the first activity? Okay, here we go. And it's a nice, easy one to start with. What I want you to do is to give me 3 ways in the live chat. So you don't have to write all 3 down. Maybe just give me your best answer. 3 ways a business can measure its financial performance. Let me get my guitar out and let's make a start. And as expected, loads and loads of answers coming through on the live chat. Lots of people mentioning it can monitor cash flow, the lifeblood of the business. Lucinda's mentioned break even. 1 or 2 people already talking about the different statements of account. So the statement of comprehensive income as being a way of measuring performance. Well, I just picked out 2 or 3 here, which I think help set the scene for this session and really set the scene for a lot of what you do in Unit 3 in relation to business finance. So, you know, you can work out how much profit you've made. Have you made a profit? And if so, how much? But also don't forget those percentage margins, the measures of profitability rather than just profit. Very important. You can measure how much you've sold in terms of volume, but of course also the value of those sales revenue. And also, financial performance is really important to measure in terms of how well you're managing the assets that you've put to work, for example, your inventory, but also how well you're controlling your costs. So those are some useful ways of thinking about why a business wants to measure and ways that a business can measure financial performance. Excellent. Right, we're into this now. So we're going to move on to a categorised activity. Now, if you with us yesterday, you'll know that with this one, we're giving you a minute. Actually, no, I'm going to give you longer. I'm going to give you 60 seconds. And what I want you to do is to categorise the 8 items listed on the screen there into one of 2 categories. It's either revenue income coming into the business that is in the nature of frequent related to trading, or is it capital income? Is it income that's coming into the business that's related to how the business is financed? So if you want to type something like revenue and 1, 2, 3, 4, if you think it's those 4, or capital 5, 6, 7, 8, I don't think that's the right answer. Anyway, let's have a minute and see how we get on. Superb stuff. Lots of answers coming in on the live chat. You don't have to type it into the live chat if you don't want to. It's just a good way of revising these two different types of income. And don't forget, this session is available as an immediate replay if you want to watch it all again. You might want to. Or if you missed parts of it, as soon as the session's finished on YouTube, it's available as a replay. And looks like we needed those extra few seconds there, didn't we? Because it was quite a challenging activity. Let's have a look. And we were lucky in the sense that these activities or these categories have 4 in each, don't they? So revenue income, this is income that's all about, the sort of the trading of the business, the sort of day-to-day activities of the business. So 2 of them are very similar, credit sales and cash sales. Cash sales, that's easy, isn't it? That's sales that we make for cash. I sell you the product, you give me the cash, thanks very much. Credit sales is I sell you the product and I give you a week or a month or 3 months to pay for it. And that's great if you can get it. Rent received, interest received, both coming into the business fairly regularly. Whereas in capital income, we're talking about sort of income that's coming in that's all about how the business is financed. So a loan, maybe a loan that comes into the business. We got a loan at Tutor over the pandemic, quite a big one actually, from the government. In it came, thanks very much, but it only came in once. It doesn't come in every week. Debentures, which we've talked about and mentioned in the live chat, that's a bond that's issued by an organisation, often a company. So they issue a loan, and that's a sort of long-term source of finance. Obviously, if they issue shares, that's capital income, and so too is owner's capital. Excellent. Now we're going to focus on this area in terms of sources of finance a bit more now for the next few minutes. We're going to do revenue and capital expenditure, and then we'll move on to sources of finance. We're going to do what's known as the example spinner. Wow, have you ever seen anything quite like that? It's a new piece of coding that we've done in conjunction with Pixar and Disney. And what happens is the arrow spins around until I stop it. So, 2 questions. And here's the first one. In each case, I want you to tell me whether the item that the spinner lands on is either revenue expenditure or is it capital expenditure? And also why? Why is that the case? And so all I need to do is for someone to say, spin the wheel, Jim, and I'll spin the wheel. You can mention that in live chat if you wish. I'll tell you what, I'll just spin the wheel. Here we go. There it goes, round and round the spinner goes. Where it ends, no one knows. It's going to be goodwill. Oh, no, it's not. It's wages and salaries, you lucky people. It could have been something really hard, but wages and salaries, what do you think? Is that revenue or capital expenditure, and why? So just give yourself 10, 15 seconds or so to firstly tell me revenue or capital, but then also, even better, maybe a sentence to explain why that's the case, why you've chosen your particular category. Lenny's gone for revenue. Bailey's gone for revenue and added a comment which is a frequent type of expenditure. Ollie's gone for revenue. Quite a few. Leo's also gone with revenue expenditure. Mike's mentioning it's frequent. It's frequent, baby. I didn't realise that was an extension of the answer, but you're probably right. Let's have a look. The answer, of course, is indeed revenue expenditure. Yeah, the payment of wages and salaries every week or every month in the case of salaries. It's a regular cost. It's a regular expense of operating the business. That's what we mean by revenue expenditure. Okay, let's spin the wheel one more time. Wages and salaries will disappear. Let's see what it gets replaced by or with. And it is a discount allowed. So let's spin the wheel. Here we go. Round and round it goes. And it's... Oh, I thought it was going to land on fixtures and fittings. It didn't. It landed on goodwill. So that's quite a hard one. So please, what is goodwill? And is it revenue or capital expenditure, please, in the live chat? If you're not using the live chat, maybe just have a think about it for 15 seconds and then jot some thoughts down. What do we think? Okay, it looks like most people are opting for capital expenditure this time. But what is goodwill? Does anyone know what it is for the bonus marks? Why is it capital expenditure? If you're right, of course. Yeah, Rachel's come very close actually to, well, actually it's a good answer, but it's comes very close to explaining what goodwill is. It is capital, and it's really the amount that you it often arises when you buy another business. And what you're doing is you're buying the reputation, you're buying the brands, you're buying the intangible value of the business. And obviously that's not necessarily the fixtures and fittings and the land and buildings and inventories. That's sort of something more, isn't it? And that's what goodwill is. And that's what makes it a capital item. And it is, yeah, it's a value of the reputation of the business that you've bought. Superb stuff. And you are allowed to include that in the statement of financial position as an intangible non-current asset. Excellent. Excellent. Well done. Right. There we go on the screen explaining what goodwill is. Right. We are flying. Who would like to have a game of the bubble quiz? Well, we're going to have one anyway, but I just thought I'd give you the chance to say, yes, Jim, let's play a bubble quiz. So if you've not done one of these before, the twist here is that it's like a multiple choice quiz, but there could be more than one correct answer, or there could be no correct answers. Florence, you were with us last night. You know what the bubble quiz is all about. So whilst we think about that, here's our first question. I think we've got 3 of these. Just let me check. Yeah, I think 3 of these. And these are all on sources of finance. So, as I say, with the bubble quiz, you need to type the letters that you believe are correct. Okay, just type into the live chat the letters you believe are correct. So, for example, in this question, if you thought that A and C were correct, you type in A and C. So which of these are internal sources of finance? A, trade credit, B, leasing, C, owner's capital, or D, retained profits? Or is it none of them? What do you think? Most people are, well, lots and lots of people having a go, and most people saying C and D. Does anyone have a different answer to C and D? What do we think? Idris is saying just D. Chris is saying just D. Chloe's saying just D. Okay, this is interesting, as long as Seb. So let's have a look as well as Seb. The answer is, it is actually just D. So let's quickly go through that, because it looks like a few people thought that owner's capital was internal. Well, trade credit, we know that's external, don't we? Trade credit is amounts that we owe to our suppliers. That's amounts that we as a business owe. They are external to the business. Similarly, leasing, you lease assets from external businesses, the leasing company. Owner's capital, well, that's money that is owed to the owner of the business. So, for example, if it was share capital that the owner owns, that's external. Or if the money has been put in by the owner, it's effectively owed to the owner. So, and the owner is external to the business. So actually, retained profits is really the only internal source of finance listed there. But never mind. If you didn't say just D, have a go at this one. Here's question 2. This is, I think, a really tough question, so don't get too worried if you're not sure about this one. Which of these would help a business raise finance by turning amounts owed by customers into cash? What do we think? So, one or more of those, or none of them, would help a business raise finance by turning amounts owed by customers into cash. Give you another 10 seconds to think about those. And as we go, if there's any terms that we come across that you're not sure about, please just put it into the live chat. I'll try to spot it. Trying to keep an eye on the live chat as well as the activities. Looks like most people, Graham has gone for D. Robert's gone for D. Daniel's gone for B. Okay, what do we think? There's a little bit of a hesitation on the live chat. That doesn't mean that everyone's not having a go, but it looks like most people are pretty sure about D, but are not sure about the others. So the answer, let's take a look and let's go through the answer. Well, in this case, the answer was C and D. Well, let's go through it. Peer-to-peer lending. No, that's just a form of lending. from somebody like Funding Circle. You may have seen them advertising on the telly. Businesses get a loan from Funding Circle. Funding Circle is funded by lots and lots of individuals who make their money available to Funding Circle to lend to businesses. Allowing more trade credit, well, that will actually increase the amount owed by customers. So that won't turn it into cash, will it? That will actually make things worse. However, there are two there that do work: invoice discounting and debt factoring. And there is a difference between the two. So just let me spend 30 seconds explaining what they are. They are both quite similar. Lyndon, hi. You wanted me to say hi. So invoice discounting, what this is an external business like, let me give an example. Hitachi Finance will loan you the money, and they basically use the amounts that your customers owe you as collateral for that. So it's a loan to you, but on the back of the amounts that customers owe you. So you're basically turning the amounts that customers owe you into cash. And once you get paid, you repay the invoice discounter. Debt factoring is slightly different but similar. In debt factoring, you actually sell the debts that are owed to you. So if your customer owes you £100,000, you sell that £100,000 debt to the debt factoring company, and they go chase it, and it's their responsibility. So both invoice discounting and debt factoring are a way of helping reduce the amount owed by your customers. In other words, reducing trade receivables. Excellent. One more bubble quiz. Which of these are external sources of finance that are often used to pay for machinery and vehicles used by a business over several years? So I'll give you a clue. It's not none of them. It's definitely one or more. But which of these are external sources of finance used to buy or finance the purchase of machinery and vehicles? And the key is that is over several years. Lots and lots of answers coming into the live chat. This is fantastic. If you're never sure about these things, if you're not quite sure, don't worry. This is why we're doing this session, just to try to cover as many key terms and formula and concepts as we can in the 60 minutes or so. Foggy's gone B, Graham's gone B, May's gone B and C. In fact, lots of people. Shelley Preet's gone B and C, as has Ollie. Stacey's gone B and C. It looks like B and C is what most people are going for. Certainly B, looking at the Noah's just corrected his entry back to B and C. Grace agrees with you. Let's have a look. It is indeed B and C, so well done if you said B and C. These aren't easy, by the way, so don't worry if you're not quite sure about these. Well, the key in the question was external source of finance, and I've already told you a few minutes ago that retained profits is internal finance, so that rules that one out. Hire purchase, well, we mentioned this yesterday, didn't we, in personal finance. Hire purchase is available to you as a consumer. For example, you might buy your Peloton bike using hire purchase, or even a better bike. Leasing, in fact, leasing is also available to individuals. Hire purchase, you take ownership of the asset once you've paid the term of the loan. It's like a loan. Leasing, you never actually own the asset. You're basically getting finance by paying a lease each month, and that's how you gain access to the in this case machinery and vehicles. So well done. If you said B and C, the bank overdraft it is external, but it's not really suitable for paying for things over several years, and the reason for that is it's very expensive. Well done. Right, excellent. Now we're going to move on to cash flow forecasts and break even for the next 10 minutes or so, and 15 minutes actually. And so before we get into this, we do need to use the dreaded word, the word that we mustn't mention, formulae. Sorry about that, but we do need to use the word formulae. So we've got a 60-second challenge, and again, I'm going to give you some extra time here. I'm going to give you a whole minute, and what you need to do here is to look at the letters down the left-hand side, the different items down the left, and can you match them with at least one, well, only one, of the numbers down the right. We'll come back to debentures in a bit. Just seen in the live chat, we'll mention debentures in a bit. Okay, so 60 seconds. Don't worry if you can't do them all. Maybe just do them one at a time. That's fine. Have a go. We're looking for that combination here, aren't we? The letter and the number. So for example, if you think that, I don't know, total revenue is the opening balance plus the net cash flow, put G4. Which it isn't, by the way. Now, don't worry about these formulae because we're going to go through these in the next 10 to 15 minutes. So don't worry about writing them all down. It's just a quite, as we'll see very soon, it is selling price per unit less the variable costs per unit. And contribution per unit is a really useful thing to remember. Certainly right up there in terms of the most important formulae to make sure that you're happy with and how to calculate it. Break-even unit or break-even output, as it's sometimes mentioned, or known, is it uses contribution per unit, isn't it? We take total fixed costs and we divide it by contribution per unit. But don't forget, with break-even units, it's in units, not in pounds. It's in units, not in pounds. By the way, if you're in a live chat, I noticed one or two people saying on your smartphone, this screen is quite blurry. If you click on the settings button in YouTube, you should be able to pick a higher resolution. It's being live streamed in high res. But your device might be defaulting to a low res. It makes it a bit hard to read on the screen. Break-even sales value is the break-even output times by the selling price per unit. Margin of safety, we'll come back to that. It's the actual output less the break-even level of output. Net cash flow, as we'll see very soon, is total cash inflows less total cash outflows. And closing balance is also a cash flow forecast or cash flow item. It's the opening balance plus the net cash flow. And lastly, total revenue, it's how many you sell, the number of units sold, times by the price. Excellent. Right. We're going to do a cash flow forecast. Can I just check that everyone can still hear me okay? Am I coming through? Am I coming through? Can you hear me? Can you hear me okay? Maybe just type into the live chat whether you can hear me. Thanks very much. I'm now unmuted. Okay, we've got a cash flow forecast to look at here. And we're going to take our go. People are saying they can't hear me. Some people are saying, yes, you can. Some are saying, no, you can't. Well, I will assume that you can. Okay, here's our cash flow forecast, and what we want to do is we want to work our way through the missing bits. So you might be given a partially completed cash flow forecast, and some of it may require you to make some calculations to help come up with the right numbers. Yeah, I knew I wasn't muted at all. I was just playing along with those who thought I was. So let's work our way through. Let's start with A. So please, can you have a go in the live chat with A in the January column here? So what was the net cash flow in January? Have a go. Thank you, Julie. Have a go. What was the net cash flow in January? If you remember the formula we've just looked at, net cash flow, I'll give you a clue. Net cash flow is total inflows, take away total outflows. What do we think? And I think Oliver and Edward were the first two in. And Oliver correctly identified it is, and so did Mo, correctly identified it is a negative number. It's a net cash outflow. Don't forget to put brackets around it or a minus sign to make sure you show that it's a negative. So total inflows were 21,000, outflows were 22,200. Therefore, the net cash flow is a negative 1,200. Now let's work out B. So if it was minus 1,200, we started with 9,000. What is the closing balance? That's the next figure type that into the live chat or have a think about it. Let's see who's first. That was one of the other formulae that we saw just a few seconds ago. The closing balance is the opening balance plus or minus the net cash flow. And Josh and Foggy and Alicia and Chloe have caught my eye in the live chat with the correct answer, which is 7,800. Excellent. Right, we're moving across now to Feb, and this is where we need to do our percentage changes. If we look at the purchases line, we're told on the left-hand side there that the business expects purchase costs to be 40% higher compared with Jan. So what would the purchases number be in February? That's item C on the partially completed cash flow. What would purchases be in Feb? Typically, there'd be a mark going for each of these things here. This could be quite a complicated question. You can pick up lots of marks by working through it. We're told that purchases are going to be 40% more than in January. And it looks like Graham, I think, was one of the first in, along with Finlay, Roberto. Oh, loads of you. Loads of you are quite rightly saying it is £19,880. Yeah, it's 14,200, but 40% higher. So we would take 14,200 and multiply by 1.4. And that will give us the right answer. Okay, moving down to D, please. We're told that with advertising, we're expecting those to be 20% higher than January. So what will the advertising number be? Wow, you lot are quick. Henry's in there, Lenny's in there. We'll see in a second. Fraser too. See in a second whether you are correct. Same principle, really, isn't it, as with our purchases costs? We're going to increase our marketing costs, in this case advertising, by 20%. So we multiply by 1.2. The answer is 2,880. Loads got it right. Toby, Millie, Lydia, all of you got that right. Superb stuff. Right, two last bits to do then. We've got the missing information. What are the total outflows in Feb? And finally, what was the opening balance in Feb? So have a go at E and F. Give yourself 30 seconds or so to have a go. Yeah, Rachel, what we do, we're told that advertising costs are going to increase by 20%. So we would take the January number and multiply by 1.2, wouldn't we? That would give us a 20% increase. So it would be 20% higher than the 2,400 in January. Okay, what have we got? Let's have a look. Give yourself a few more seconds to have a go, if you're having a go. And let's have a look. 28,360. Loads of people got that right. Looking at the live chat, that's the difference between total inflows of 32,000 and our total. So that is the total of all those outflows. And then we can check that because the net cash flow is right, 3,640. And don't forget the opening balance. This is an easy mark. The opening balance in 1 month is always the closing balance from the previous month. So very easy. Always remember to do that. The opening balance is the previous month's closing balance. So 7,800. Superb. That would be a good example of a cash flow forecast, a partially completed one if you got given one of those tomorrow. Lots of marks going for that. Let's just do a quick activity whilst we're on cash flow forecasting. In the live chat, please, type in an advantage, please, to a business of doing a cash flow forecast. Just give me one. An advantage of doing a cash flow forecast. How does it benefit the business? Lots of different possible answers. But if the examiner said, give me an advantage of cash flow forecasting, what would you put down and why would you put it down? Give you another 15 seconds to have a thought. Those are loads of people going into the chat. Lots of people picking up on how it helps you plan for expenditure Unicorn Slayer, great name, is pointed out that it's really useful as a something to show to the bank if you're asking to take out a loan. It helps prepare for and see whether you are ready for unexpected cash outflows. It tells you whether there's going to be a surplus or perhaps most importantly a shortage of cash. Superb. I think the two that we've got on here on the suggested answers on screen there are pretty much what you've written. You've got some better answers actually in the live chat. So yeah, it was mentioned by a couple of people that a cash flow forecast is really useful. In fact, it's absolutely essential if you want to raise finance either from a bank or from, for example, by issuing shares. So when Tutor2U got a bank loan 2 or 3 years ago, a couple of years ago, we had to put quite a detailed cash flow forecast together because the bank was helping us fund our growth in our business. And cash flow forecasting was a big part of it. And also it really helps you month by month and week by week work out whether you are going to run out of cash. And for example, do you need a bank overdraft? So it's really good stuff. What about some of the disadvantages? It looks like 1 or 2 people already having a go at the disadvantages. So type a disadvantage now, please. So a bit of balance here. So you've given me some fantastic advantages. What about some of the drawbacks, the potential disadvantages of cash flow forecasting? You may have saying time consuming. Terran's saying not necessarily accurate. Sadie's saying not necessarily up to date. Time consuming has been mentioned in 2 or 3 contributions into the live chat. Umair's also mentioned it, a great point, that it's at the end of the day it's based on predictions. And the only thing that you know about predictions is they won't come true, will they? Well, they may come true, but not necessarily because of why you predicted them. Yeah, fantastic stuff. Let's have a look what we got. Let's see what. Oh, there we go. Let's compare these with what we had there in the live chat. It's hard to forecast all unexpected events. So, for example, an unexpected cost. Yep. I mean, with cash flow forecasting, you can usually add something in there. It is what I would call a contingency to say, you might have a line that says unexpected items, £10,000. You don't know what they're going to be, but you might adjust for them. But you wouldn't necessarily pick up everything that might happen. And of course, don't forget, as many of you said, it's a prediction. So Dilla's just said it's a prediction. So it's not going to be accurate. You might get the sales prediction wrong. You might be too optimistic. You might be too pessimistic. You might not necessarily forecast all your costs and your payments out correctly. So, they're not perfect, but they are a very good discipline for businesses to use. Superb stuff. Right, we're going to move on now to break even. So we've done some good stuff there on cash flow forecasting. We are rattling through the Unit 3 business finance tonight, and bang on time as well. Now with break even, we really do need to know our formulae. It's probably the most important thing, as well as understanding the concept. So on the screen there, we're just going to go through the formula again. What is the formula for break-even output, please? So pick items, but not all of them, from the list that's on the bottom of the screen. What is the formula for the break-even output in units? Hopefully you know this, but all the items are on the screen there, but not necessarily in the right order, and you don't need them all. Yeah, I think we have it. Most people have really got that spot on. Different ways of writing it down, but basically saying the same thing. Break-even output is our total fixed costs divided by our contribution per unit, that really important measure. Don't forget, contribution per unit is selling price less variable cost per unit. Oh, did I mention the answer to a formula that's coming up? Okay, what about the margin of safety? This is something which students don't often remember, but often examined. So what's the margin of safety? Have a go. If you've not come across that, or if you've forgotten what it is, don't worry, we will go through this. What is the margin of safety? Wow, loads of correct answers coming in. This is very encouraging. Don't forget, you need to know your formulae. Obviously, you also need to be able to apply them, but knowing them is a big part of break-even analysis. So yeah, Gabriella, amongst others, Kurt, Joel, Jack, all of you, and Graham getting it right. The margin of safety is the actual output, how many you actually make or sell, less the break even and output. So the margin of safety could be hopefully positive. Hopefully you make or sell more than you need to in order to reach break even. But of course it could be negative, couldn't it? In which case you're making a loss. Now, contribution per unit, quick one please. What's the formula there? I think we've mentioned it twice now. Contribution per unit, what is the formula? Actual output, Sanya, is what you make and sell. Often it's about what you make, and you assume that you sell what you make. But actual output is basically what you make and sell, compared with the break-even output, which is how many you need to make and sell in order to cover your fixed costs. Yeah, contribution per unit. Lots of people have got this right. Well done. So we're not going to spend too long on this. We're going to have a go in a short while. Selling price per unit less variable cost per unit. A really, really important thing to remember. Contribution per unit. I don't know. I mean, it's got to be the most important measure in break-even analysis, and it always comes in handy. Okay, right, now that we've reminded ourselves of the formulae and you've shown that you really know them well, let's do a little bit of calculation. So with this one, we've only got 30 seconds. Okay, but the good news is it's going to be the same information each time. So I've provided you with some information about my business. It's a really interesting business. I've no idea what it does. On the left-hand side there, fixed costs, variable cost per unit, selling price per unit, and number of units sold. So your first contribution, please. 30 seconds or half a minute if you want a bit longer. What is the contribution per unit? Suey, nice one. £45, isn't it? Well done. Now, don't forget, with calculations in Unit 3, the best thing to do, even if you think you're absolutely sure about the answer, is to follow the three-step approach. The first step is always to write down the formula. I'll explain why in a second. In this case, it's selling price per unit less variable cost per unit. We then substitute the numbers we're given into the formula, and that will tell us what we're missing. So in this case, we substitute 85 and 40. We're given those two, and then we do the calculation. So in this case, it's £45 per unit. Why do we do this? Well, if you got the right answer, you'd be given the marks. But if you got the wrong answer, maybe your calculator slipped or whatever it is, if you'd written down the formula and then started substituting the numbers, you can still get marks. And every mark matters in Unit 3. So always follow this approach, even if you're absolutely sure that you know the answer. Okay, next question. Calculate the total revenue. By the way, this bit is easy, so it will get harder. What's the total revenue per month? Yeah, somebody's asking what's the best way to memorize these formulae, and I think the best way is to practice them. I think that's the best way. Then they become quite familiar after a while. Well, total revenue is, of course, our formula. It's selling price per unit times by how many were sold. So in this case, we're told £85, 1,500 units, £127,500 is the revenue. Next one. Now, calculate the break-even output, please. So lots of answers coming through here, but not all of them I'm going to give full marks, even though the number looks right. So I'll give you the chance to correct your answer. Oh, Graham, well done. Thank you, Graham, for reminding us that break even is not in pounds or just a number. Break even is in units. So the formula, remember, fixed costs divided by contribution per unit. Well, we already worked out what contribution per unit was, which is £45. And our fixed costs were told those 65,250. So we take one number, divide by the £45 per unit. But don't forget, the answer is in units. 1,450 units. Now, if your calculation comes out to be something which isn't a whole number, let's say it was 1,450.6 units, then you need to round up to the next whole number, because obviously you can't have 0.6 of a unit. Well, you could, but it probably wouldn't be very good. So always round up if your calculation comes out to be a funny number. It could be that you've got the calculation wrong, I suspect. But anyway, always double check. Right. And lastly, calculate, please, the margin of safety in units, please. And most people are saying 50 units, which is very pleasing to see, having just made the point about how we measure not just break-even output, but also the margin of safety by units. The margin of safety, the difference between how many we actually make or sell and the break-even output. In this case, we were told we're selling 1,500 units. We were told the break-even output is 1,450 units. Therefore, our margin of safety isn't much, is it? It's just 50. Well done, Arnav, for actually writing down the formula and the correct answer. That's exactly how you do it in the Unit 3 exam. Now, here's a clever trick. If you want to work out what the profit of a business is, multiply the margin of safety by the contribution per unit. It's the magic formula that no one ever tells you, but it's true. You can always work out the profit of a business by calculating the margin of safety by the contribution per unit. Superb. We do have a couple more calculations coming up in a second for those of you who love them. But just here's a little extra activity. Somebody was asking about break-even charts in the live chat just before we started. So I thought I'll just quickly do a break-even chart activity. And this one's called the suitcase scanner. The suitcase scanner. What I'm going to do is, this is footage that we've just obtained from Melbourne International Airport of Novak Djokovic's suitcase. And it turns out he carried his tennis rackets as hand luggage, but in his suitcase he had a very large piece of card with a break-even chart on it. And this is the actual footage of what was on that break-even chart. So look, what I'll do is I'll show you the footage, and you need to answer this question. What are the fixed costs of this business? Are we ready? Here we go. Do you want to see that again? What about, do you want to see that again? Maybe one more time? Here we go. Well, lots of people having a go, and well, some people saying 30, but lots of other people saying 30,000. What's the answer? The answer is it is 30,000. 30,000 pounds. Break even. The fixed costs, the fixed cost of the business. It's the horizontal line, isn't it? So at 30 on the axis, but we're told the axis was in thousands of pounds. Fixed costs, they don't change. That's the thing we have to try to cover by selling output. And so let's have a look at Novak's suitcase again. What would the margin of safety be if the business has an output of 5,000 units? Have a go. What do you think? What's the margin of safety? And Sagar, I think, hopefully that's the correct way of pronouncing your name, is first in with the correct answer is 1,000 units. You might be asked to interpret a break-even chart. You might be given that information as a chart rather than information in a table or in words. Don't forget, our break-even point is where total revenue equals total costs. At that point, we don't make a profit, but we don't make a loss. And if we work down, we find out that that's at 4,000 units of output. Well, I said that the business was making 5,000 units, so the margin of safety is 5,000. Take away 4,000. There we go. Now, I can guarantee you that suitcase will not appear in tomorrow's exam, or indeed any further Unit 3 exam. If it does, well, you've seen it here first. Right, let's move on for the last part of this session. We've got about 12 or 15 minutes to go. We've looked at break-even and cash flow there, done lots of that. How about a bit of statement of comprehensive income and statement of financial performance, starting with a game of bingo? Why not? So, somebody's asking, shall I explain the margin of safety again? Let's go back. Somebody's saying, can you please explain that again? Miss Pepe is saying you're confused. So the margin of safety. The margin of safety is the difference between our actual output, which we were told was 5,000 units, and the break-even output. Now, in this case, the break-even point is where we don't make a profit, but we don't make a loss. And that's where total revenue, in this case, the pink line, crosses the total cost line. So if total revenue equals total costs, we've not made a profit, have we? But we've not made a loss. That's the break-even point. And therefore, the margin of safety is 5,000 less the break-even point, which is 4,000. Okay, quick game of bingo. We'll do this really. Okay, I think we're back now. I think we're back. There's a little bit of lag there. YouTube is having a problem. Oh, good. I think we're back. Yeah, YouTube was lagging there, but I think we're back. So please type into the live chat any items that you would expect to see on the statement of comprehensive income. Sarah's first in. A cost of goods sold. Very good. That's important in terms of gross profit. Net profit. Gross profit, says Alex. Revenue, says Jonathan. Lots of stuff coming in here. Let's have a look. Let's make sure we know what all of these things are. The first thing that's coming out of the Socky bingo machine is revenue. The top of the statement of comprehensive income. It's the value of what we sell. Next up, otherwise known as turnover. So sales revenue or turnover, same thing. Cost of goods sold. That's where we are able to work out our gross profit. So don't forget a key formula. Gross profit is revenue less cost of goods sold. There's our third item. These aren't necessarily in the same order you would see them on a Socky. Expenses. So these are like overheads. So it might be your rent, or it might be your marketing costs, maybe some salaries that aren't directly related to production or sales. Next up, profit. So don't forget you would expect to see profit on a statement of comprehensive income. That's what it's there for, to work out and show what profit you made. And lastly, on this bingo machine, other income. So that could be, I don't know, it could be some rent received or perhaps some interest received. So the statement of comprehensive income is there to help you work out particularly how profitable the business is. And that's where you get the profitability ratios that we've covered in a separate live stream just before Christmas. Let's just do a couple of calculation countdowns on these. These are 30-second calculations. 30 seconds. So here's the first one. Calculate the cost of sales with that information there. I'll give you 30 seconds. Tom's asking, what do I do in those 30 seconds? Well, I just sort of basically watch the clock and watch the live streams coming in, and most people have done really well on this. The answer is 18,460. In fact, I would say everyone who's had a go in the live chat has got that right. Don't forget a key formula. Cost of sales is our opening inventory, what we start with, plus what we buy. Take away what we haven't used yet, the closing inventory. So in this case, it's 7,040 plus what we buy, 20,620. But take away the closing inventory because we've not used that yet. So we can't include that in cost of sales. 18,460. Right, there's two more and they get progressively harder. So have a go at this one now. 30 seconds or half a minute if you want a bit longer. This one is about the gross profit. So have a go at this. Now, we didn't need to use all the information in this one, so lots of people have got the right answer. And just to explain how we get to that, yeah, you're correct, Alex. Well done. Farding, well done. 83,600. We didn't need to use the expenses, did we? Because we were just asked to calculate gross profit. So in this case, that's just revenue less cost of sales. If we were asked to calculate profit, we would need to take off the expenses off the gross profit. But gross profit is just revenue less cost of sales. So that's why it's really important in all your calculations always to write the formula down and then substitute the numbers, because you may not necessarily need to use all the numbers. Okay, now this one is about total sales, but based around using percentages. You might need to sort of do a reverse calculation here. Have a go at this one. A little bit harder, that one, wasn't it? A little bit harder. So let's go through the answer. Don't forget, we always show our formulae. Now, we're told the business has achieved a gross profit margin of 60%, which and cost of sales were 220,000. Well, if cost of sales were 220,000, that must mean that they were 40% of revenues, because the rest of it was gross profit. So the way to work out sales revenue is to divide 220,000, which is cost of sales, divide it by 0.4 or 40%, because that must mean what the sales revenue were, which must mean therefore that the gross profit was 330,000. So absolutely vital with those kinds of reverse calculations that you write the formula down, take it step by step. Excellent. Some people are asking, can you have a toilet break during these activities? Yes, you can, but you've only got 30 seconds to do it. And here is your next 30-second activity, the last calculation here. And this is the hardest one of the night. This is about market percentage. So have a go at this one. And I'll go back to the question before I show the answer, because a few people are asking about this one in the live chat. So let's go back and explain. We were told that the gross profit margin was 60% of sales. That must mean that cost of sales were 40%, aren't they? Because if you think about it, for every £100 of sales, it's either cost of sales or gross profit. So if gross profit is 60%, cost of sales must be 40% of sales. And therefore, to work out sales, we just divide cost of sales by 0.4. That tells you what the split was between gross profit and cost of sales. Hopefully that was useful. We're not going to have that music again. And we'll just go to the answer for this one. This was markup. A little bit harder, but well done, Nisa, in particular, for getting that right. You were very quick. Markup, the formula is gross profit divided by cost of sales. It tells us, if you like, what's the relationship, that the fraction between how much gross profit we make for each pound of gross sales. And in this case, we were told it's 300%. So for every £1 of cost of sales, we would expect to make a gross profit of £3. So our cost of sales, if the gross profit is 450, our cost of sales must be a third of that, £150,000. So don't forget, the market percentage is a tricky one, isn't it? It's gross profit divided by cost of sales. As always, write the formula down. You won't go far wrong. Right, we're almost there. We're just going to do a couple of activities on the statement of financial position and then finish off with some quick fire multiple choice questions. So hang on in here for... No, it's gross profit divided by cost of sales is the markup percentage. So we've got a categorised activity. We've got 3 categories in the statement of financial position. We've got non-current assets, which I've shortened to NCA. Current assets, I've shortened to CA. Current liabilities, I've shortened to CL. It should say CL rather than CA. So all you have to do is just write down which category do these 8 items fall into. So either NCA, CA, or CL. Not CA, CL for current liabilities. So have a go. Keep going if you're having a go at that. We'll have a look at your answers. Just going back to that previous question, you're right. Market percentage is gross profit divided by cost of sales times by 100. And we were told the answer was 300%. That was the market percentage. Therefore, if gross profit was £450,000, to get to 300% markup, you must have had cost of sales of 150,000, which is why that was the correct answer. Well, let's have a look at this one. It's important to remember the different categories because it really helps you when you look at ratios, particularly liquidity ratios and efficiency ratios. So non-current assets, that's the bit at the top of the statement of financial position. They include goodwill and land and buildings. So well done if you got those two. Current assets, CA, inventories, trade receivables, cash and prepayments. And on the other side there, current liabilities, 2 of them, trade payables and accruals. So just a quick fire extension question. Give me the formula, please, for the current ratio. You could calculate that based on the information on the screen there. What is the formula for the current ratio? One of our liquidity ratios. Chico, I'm going to go through what an accrual is in a couple of minutes, as well as a prepayment and also depreciation. What is the formula for the current ratio? Well done for Yana, Riyadh and Solid, along with generic and Katie Marie. Correct first in the live chat. It's current assets divided by current liabilities. The current ratio. Excellent. Lots of marks going for knowing that. Now we're just going to have a look at depreciation and also accruals and prepayments. So let's have a look at depreciation first. Somebody's already mentioned depreciation earlier in the session when they were talking about items that would be in the statement of comprehensive income as an expense. But how does it get there? Well, the reason why is depreciation is a means by which we allow or adjust for the reduction in value of tangible assets that we own over time. So we're told some information here, a calculation for you to do. A business has a new machine which cost £40,000. Two things. Firstly, calculate the depreciation for the first year of ownership using the reducing balance method at 15% per annum. And secondly, please calculate the net book value at the end of the first year. So two things to calculate: the depreciation for the year and what is the resulting net book value. Have a go. Give yourself maybe 25, 30 seconds to have a go. Oh, lots of great answers coming in here. This is good news. So yeah, depreciation has been pointed out by a couple of people in the live chat. It's how we just reduce the value of an asset that gets worn out over time. Might take a few years, might take longer. Excellent. Well done. I can see lots of correct answers coming through. Let's have a look at how we get to them. Well, first of all, the depreciation is £6,000. That's a cost for the business. That's £40,000 times by 15%. Times by 15%. That's how we get to the depreciation in the year. That's an expense in the business. And how do we get to the net book value? Well, we started off with £40,000 of value, but we've said it's not worth as much as that now. It's £6,000 less because it's depreciated. It's got less useful, less valuable. Therefore, we simply take one from the other. £34,000 is the correct answer. That's the net book value. Now, if we depreciated it the next year at 15%, it wouldn't be on £40,000 using the reducing balance. It will be on £34,000. So the depreciation next year will be less. So, quick question for you in the live chat. What is the difference between, well, firstly, between depreciation and amortization? We've mentioned depreciation before, but we've not mentioned this other word that's in the specification, which might crop up tomorrow. What's the difference between depreciation and amortization? What do we think? Have you heard of amortization before? Let's take a look. Well, depreciation is what we've just done. We've reduced the value of tangible assets like machinery, land and buildings, by applying a policy. Previously, it was reducing them by 15%. Amortization is a similar idea, but it's relating to goodwill. It's goodwill. So, for example, maybe you've got goodwill as a non-current asset of £1 million. You might amortize that over, 50 years or 20 years. So it's similar to depreciation. It's a way in which you can reduce the value of goodwill or non-current assets. Excellent. Now, another question, and this is potentially more likely in the exam. What's the difference between the two different methods of depreciation, straight line and reducing balance? Does anyone know what the difference is? What do we think? Yeah, absolutely right in live chat. Yeah, basically, depreciation is tangible non-current assets. Amortization is intangible non-current assets, but the same principle. We're going to come on to accruals and prepayments literally in a minute. Does anyone know what the difference is between straight line and reducing balance? They're both methods of depreciation. Excellent. Thank you very much. In the live chat, straight line goes down at the same rate. Reducing balance goes down as a set percentage of the net book value. Well done. They are both methods of depreciation. Both are allowed. It's entirely up to a business which one they use. But basically what happens is in straight line, it's the same amount of depreciation each year. Whereas reducing balance, the amount of depreciation goes down each year. That's the only difference. And hopefully you know how to work out the two of them. Superb stuff. Right, we have, 5 minutes or so left. Let's just do prepayments and accruals. Someone was asking me in live chat, what's an accrual? We're about to find out. So, we're almost there. Stick with us. On the left-hand side there, some information. A business had a financial year end of 31st of December, New Year's Eve each year. On the first day of November 2021, The business moved into new offices and paid the landlord £30,000 to cover the first 6 months of rent. In January 2022, that's this month, the business agreed to pay a customer £5,000 of compensation for costs of some faulty work done early last year. How would those two items be adjusted in our statement of comprehensive income and our statement of financial position? So let's deal with the first one. What about the new offices, paying the landlord £30,000 worth of rent to cover the first 6 months? What is that going to be? What kind of adjustment do you think we would make for that? What do we think? Have a go in the live chat. I'll give you a clue. It's one of either an accrual or a prepayment. What do we think it is? Give you a few more seconds. Not easy, this. And first in to the live chat with the correct answer is the appropriately named staff, who said it's a prepayment. It's a prepayment, Jim. Let's have a look. And lots of other people are now saying a prepayment. Let's explain why that is correct. It is indeed a prepayment. Let's take our time on this. A prepayment is where we pay money, but some of the benefit happens in a later period. So we don't want to necessarily take the whole payment into our statement of comprehensive income because some of it's for next year. So in this case, we have paid out £30,000, but actually we've only had 2 months of rent, haven't we, by the end of the year? 4 months, January, February, March, April next year. Well, that's next year's numbers. So we've prepaid. We've given the landlord some money in advance. So our prepayment would be 4/6 of £30,000. In other words, £20,000 is for next year. We'd show that as a current asset. Prepayment's £20,000. And we'd also adjust our profit. So rather than it showing £30,000 for that rent payment, we would only show £10,000. So a £20,000 higher profit. That's the idea of a prepayment. So Will's absolutely right in the live chat. 2 months of that 6 months goes into expenses. The other 4 months is a prepayment. Okay, what about the compensation for costs? What about that dodgy work that was done? What do we think? The £5,000, how are we going to adjust for this if we got something like that in the 2021 statement of comprehensive income? What do we think? Have a think about it. It's obviously not going to be the same as how we adjust the rent. And Kix is first in. It is indeed an accrual. What a funny... So actually, no, it was Eleanor who was first in, and Chloe and Carrie very quickly afterwards. It is indeed an accrual. Shall we have a look and explain why that is? Well, this is an accrual. We need to adjust for this to reflect the fact that there is a cost that we've incurred in 2021 that needs to be in the numbers, isn't it? So we've done some dodgy work. We've paid out £5,000 after the year end. So we need to say, well, no. We need to reduce our profit, increase our expenses by £5,000 and show that amount that was owed. We really owed that at the end of the year, didn't we? Even though we paid it later after the year end. So that's the idea of an accrual. Paying for dodgy work. I don't know whether I've ever told you this, but I used to have a job as a kitchen cabinet maker. And I got sacked for really shoddy work. Still, as one door closes, another opens. Now, over to you. Please give me 2 examples of a prepayment, please. Typical prepayments. Unicorns in there, prepaid cards, excellent. So here it's going rent payments, the lecky, the electricity, Okay, excellent, superb stuff. Yeah, I mean, it's just worth knowing a nice list of the typical items for prepayments. I asked you for 2. I've put 3 on the screen there. Rent and rates. You typically pay for your rent and your rates in advance. Insurance. So don't forget personal finance. If you pay insurance, you pay for the year, but you often pay at the start of the year. So that can often be a prepayment. But also anything where you put down a deposit. For example, you might buy some mobile phone allowance for the next quarter or next month. Anything which is an advanced payment for a future benefit is a good example of where you might need to adjust for a prepayment. Fantastic stuff. Right, we are going to finish off, and I truly convince you that this is the last part. We're going to finish off with 5 quick-fire not MCQs, true or false. Not MCQs, true or false. So this is really easy in terms of what you need to do. You just need to write true or false. But the questions are not easy, and these are all in relation to ratios. Don't forget, we've done 3 live streams on the efficiency, profitability, and liquidity ratios, but this is just a nice way to finish off the last part of the specification. So, true or false, an increase in the gross profit margin of a business will always lead to an increase in the profit for the year. True or false? What do we think? It's going to be 15 seconds for each of these. Most people typing false. And by the way, if you've been with us the whole session, I recognise lots and lots of names in there. Fantastic. This is amazing work. You need to put your feet up after this and relax because you're in good shape. Well done. Yeah, the answer is false. It won't always lead, will it? The gross profit margin might do, but it depends. It depends on whether, well, firstly, how many items you've sold, but also what's happened to your expenses. If you don't forget, profit is gross profit less expenses. So it could be your expenses are a lot higher. So your profit for the year might be lower. So it's false. Okay, next one. The return on capital employed is a liquidity ratio. The return on capital employed is a liquidity ratio. What do we think? You've got a 50% chance of getting this right. True or false? Will's gone false. Connor's gone true. So already we've got a difference of opinion in the live chat. But not many answers. Is that because we're not quite sure? Okay, let's have a look at the answer. It's false. No, the return on capital employed is a profitability ratio. It looks at how much profit we make. Profit for the year, net profit divided by capital employed. It tells us how much profit we make based on the assets that we employ in the business. It's a profitability ratio. So if you're not quite sure, watch our recent live stream on profitability ratios. It's only 25 minutes. Well worth a look as you're having your tea. Next question. A business pays cash to increase the value of inventories held. This will have no effect on its current ratio. What do we think? True or false? A business pays cash to increase the value of inventories held. This will have no effect on its current ratio. What do we think? If you think about what is in current assets, that will help you. And you've already told me earlier on in the session what the current ratio is, which is current assets divided by current liabilities. Florina's going true. Jimin, who's been pretty much on fire tonight with answers, is also going true. And now he's just changed his answer to false. And let's have a look. The answer is it's true, isn't it? Because if you pay cash to buy more inventories, it means you've got less cash but more inventories. In other words, the value of your current assets hasn't changed. Your cash might be down by £5,000, but the value of your inventories is up by £5,000. So it won't affect your current ratio, but it will affect your liquid capital ratio, which, don't forget, we ignore inventories in that one. Excellent. 2 more to go. And these aren't easy, by the way. We're finishing on a high. An increase in trade payables days and a fall in trade receivables days should result in an improved short-term liquidity position of a business. What do you think? Fadim, we're not going to go through exam structure, question structure today. This session is really all just about, as quickly as we can, covering lots and lots of different topic areas, formulas, that kind of stuff. What do we think? An increase in trade payables days and a fall in trade receivables days should mean that your short-term liquidity position is improved. It's better. What do we think? Okay, let's have a look at the answer. Well, I think the answer here is true. So if you said that, well done. Let's explain it. If trade payables days go up, that means we're taking longer to pay our creditors. So we've got more cash in the bank and we owe them more, but more cash in the bank. If trade receivables days fall, that means we're owed less money by our customers, isn't it? It means we've got more cash in the bank and less owed by our customers, both of which should mean that we get more cash in the bank in the short term. We may not be able to keep that going forever, but yes, it should be true. Wouldn't it be great if we had true false questions in the exam? But we don't. But we're finishing off on this one. A significant increase in inventory turnover days suggests that a business is managing its inventories less efficiently. What do we think? Whilst we're doing that, somebody's asked for me to explain one last time what a debenture is. A debenture is a loan that's issued by a business. It raises finance by issuing a loan that maybe customers give the company money for the loan, and in return the customer or the loan holder, the debenture holder, gets paid interest. So it's a loan issued typically by a business. What do we think? True or false? Most people going, oh, actually, I say most people. Actually, most people are saying false. Okay, well, I think the answer here is true. It means you're managing your inventories less efficiently. If you've got more inventory turnover days, it means it's taking you longer to turn your inventory over. Let's say you've got 100 days of inventory rather than 50. That would be an increase in turnover days, wouldn't it? That would mean that your inventory is turning over more slowly, less efficiently. So if you're a bit unsure on inventory turnover, I highly recommend you have a quick look at the last part of our efficiency live stream, just 10 minutes, where we go through the whole of inventory turnover. How do we get on? 1 out of 5, somebody says. That's fine. Just having a go is good. DJ has gone 4 out of 5. That's pretty good. Those were tough questions. Really tough questions. Right, team business. That is it. That's it. We've done, 80 minutes of rapid fire revision. We've covered loads there, haven't we? Break even, cash flow forecasting, accruals, prepayments, depreciation, you name it, we've covered it. It's meant to be a rapid fire overview of key concepts, key formula, and you've done fantastic. So if there are bits and bobs that you're not quite sure about, you can either watch the replay or watch some of the other live streams or just do a little bit of extra revision. But the most important thing now is to make sure you've got enough time to rest up before the Unit 3 exam. Don't forget the key things. Always write your formula down. If you're not quite sure of how to calculate things, you might get some marks for that. And most importantly, have a go at all the questions. Section A, personal finance, 28 marks. Most students do it in about 40 to 45 minutes. Loads of time. Have a good go at every question in that section, as well as section A, where you've got the rest of the marks, 52 marks. It's 80 marks now, but you've still got 2 hours. So loads of time to give each question a decent go. And trust me, you'll be absolutely fine. From everyone here, Graham and Susan and all the rest of the team who are involved in producing all of our BTEC resources and have helped me put this session together, a huge thanks to them. And we're wishing you all the best. We'll keep our fingers crossed for those of you taking the exam if you're with us live in the morning, and for any other students taking Unit 3 who are watching this on YouTube. As always, we ask, give us a thumbs up if you found the session useful. Subscribe to the channel, because we'll be doing lots more stuff for the summer exams. But for now, I'm going to sign off and wish you all the best. See you later.